Welcome back, everyone. In this episode of the Joseph Carlson Show, we're going to be looking at earnings reports of companies reporting earnings this week. Now, if we go ahead and look at the board here, we have a whole list of companies that are reporting earnings throughout this week, from Monday to Friday. And overall, these companies I think are important, but they're not the most important companies in the market. These aren't the market movers. There's no Nvidia, Amazon, Apple reporting this week. That stuff happens next week and the week after. So I'll have additional videos leading up to those weeks, but this week we do have a couple really important companies. For one, we have Goldman Sachs that reported earnings this morning. I like to look at them as an investment bank and see how that side of activity is doing. We already had news that they did really well, so we'll be looking at them. Then tomorrow morning, before market open, going down this list, we have UnitedHealth Group. UnitedHealth Group is a genuine compounding machine. The company has phenomenal fundamentals. I'll be going over my predictions of their earnings this week. We also have ASML. This is another compounding machine, a company that's been on my watch list for a while, and they're reporting earnings Wednesday before market open. Now, I'll be giving you my prediction as well as a brief summary of what ASML really does, from someone that really knows a lot about the company. So we'll be looking at that as well. Then moving on to Thursday, we have the biggest earnings report of the week, which is Netflix. Not only is it one of the biggest companies reporting, but it's reporting first before the rest of big tech. So this one is kind of standing out there on its own. It's one of the few to report this week that's a really big technology-focused company, and that makes it more volatile and more interesting. Everyone has an opinion on Netflix, but I'll be going through more in depth of what my expectations are this quarter for Netflix's earnings, for their cash flow, for their subscriber gains this quarter. So I'll be looking at that one as well. And then Friday, we have two companies reporting before market open, which is American Express and Proctor Gamble. We'll be looking at those as well. So we have a full list of companies to go over. Now let's go ahead and start off. We'll start from left to right, work our way through the week. We just had Goldman Sachs report earnings. Let's go ahead and take a look at how Goldman Sachs did. On Qualtrim.com, we have Goldman Sachs Group up 3.58% today. The quick summary of this by Qualtrim says, Goldman Sachs shares are trading higher after the company reported better than expected Q1 earnings per share and revenue. So they had a beat on earnings per share and revenue. Now to dive further in this, we can move over to the Wall Street Journal. They say Wall Street powers Goldman Sachs to sharply higher first quarter earnings. The bank on Monday said that quarterly profits were up 28% from a year ago. So 28% increase in quarterly profit. Revenue was up 16% from a year ago. That beat analyst expectations as well. Goldman shares are up around 3.8 now. They were up 4.5%. So it's given up a little bit of the gains. Goldman's results reinforce the reasons behind its current strategy to refocus and expand on its core business serving Wall Street and asset and wealth management clients, while moving away from its ill-fated foray into consumer lending. So Goldman Sachs has always been a bank for wealthy people, wealthy asset managers, lots of money, Wall Street, that have used this bank for all those services. And that's been very lucrative for them. But then they said, hey, there's this whole retail market, and there's other banks that seem to be going into this. There's financial service companies like Ally Financial, like Robinhood, like SoFi, like M1 Finance. All these little fintech companies that are focusing on the little guy. They're not focused on Wall Street at all like Goldman Sachs is. And Goldman Sachs is, of course, saying, well, we want to stick our hands into that, to that cookie jar as well. We want to get those retail clients as well. The problem is the way that Goldman Sachs did it was they partnered with Apple. And Apple's so big and powerful, they didn't give Goldman Sachs good terms on their Apple Card. So Goldman Sachs lost money on the Apple Card. Apple made money on it, Goldman Sachs lost money. So now they're pulling back from this ill-fated foray into consumer lending. And I don't think this was a problem with their direction to move into consumer lending. I think it was with their execution. They should have known that if they're going into business with Apple and they're trying to manage the economics with Apple, that Apple's going to have a massive upper hand. Goldman Sachs is big, but Apple's orders of magnitude bigger. So this was a problem with their strategy. Other companies like SoFi and Ally Financial are not partnering with Apple as part of their core strategy because they know they wouldn't get the best terms doing that. But regardless, now Goldman Sachs is moving away from consumer lending. They're getting out of the little guy and they're moving back to Wall Street and wealth management clients, where there's a huge pool of money for them to get. And you can see the results here. Revenue from investment banking and trading, both powerhouses of the company, were both up for the quarter. So these wealthy clients are making them more money. Trading revenue was up 10%. So these are big winners for Goldman Sachs. So overall, I think this is a good view into the economy. We know that trading firms, that wealth management and wealthy clients are doing well. Their services are increasing. This doesn't say much about consumers because I think this is poor execution more than a broader view on the consumer. I still believe that this doesn't say much about credit card companies or consumer lending all around. When I look at Goldman Sachs, I do not invest in this company because I don't believe it's a compounding machine. I don't believe that these financial services are reliable compounders. If we go down to the free cash flow, for example, and we take a look at that, look at it on a longer timeline. We can even zoom in for the past 10 years. This is the free cash flow of the company, which is all around every direction. You don't know what you're going to get in terms of cash flow. So even though Goldman had a great report, it's not one that would fit into my portfolio. Now, moving on, we jump into Tuesday before market open. There's one company that I thought was worth talking about, which is UnitedHealth Group. This is a genuine compounding machine. This is an incredibly strong company, and that's proven by the ongoing fundamentals. UnitedHealth Group is an insurance company for healthcare. So they have the leverage that comes along with insurance companies, but then they also have these secular trends of healthcare becoming more expensive every single year. This combination for decades has allowed this company to grow its revenue and economics routinely year over year. Let's go ahead and take a look at the revenue here. This is incredibly consistent revenue growth. Ever since 2006, they've grown it mostly organically for a decade, and then going on to the next decade, up to $371 billion in revenue, which is just incredible. Growing at a rate of around 10.5% for the past 5 years, and not slowing down year over year. Last year, they grew at 15%. And that is in line with healthcare costs. They've gone up around 15% per year. So healthcare costs are going up too quickly. It's becoming too expensive for the average person. And this company is benefiting from that in the process. Then we look at the free cash flow of the company. Now, here's what you have to know about stocks, and a lot of people don't understand this. The best estimator of the intrinsic value of a company, I believe, is free cash flow on a per share basis. That is the best look at the amount of cash you get as an investor for every single share you purchase. You're purchasing these companies because of the cash flows they generate. So their free cash flow on a per share basis shows you how much cash they're generating while considering dilution into the mix. When we look at UnitedHealth Group, this company has generated around 15% free cash flow per share growth over the past 5 years. So we go back the past 5 years, and they've averaged 15% free cash flow per share growth. Well, if you look at the math here, if something grows by 15% compound annual growth rate for 5 years, that's around a 100% gain. So 15% every 5 years is a double. That's how the math works. And again, the free cash flow per share growth is the best estimate of the intrinsic value of the company. So by my quick estimate of this company, the intrinsic value of the company has likely doubled over the past 5 years. Now we can look at the stock price and see if the stock price has doubled. This will happen in most cases, but it doesn't happen in every case because the company could have started off really expensive. But again, in most cases, the company's stock price will follow the free cash flow per share. When we look at the past 5 years, the stock price is up 102%. Almost perfectly a double, and almost perfectly a double in the free cash flow per share. This is no mistake. There's no magic here. It is simple mathematics. Company grows free cash flow per share, the company gains in market value. This is why for every investment that I look at, I try to find ones that grow their free cash flows per share at 15% per year so that I can double my portfolio every 5 years. That's the goal overall. Now, it's hard to predict that going forward, and that's why we have to find really good companies to accomplish that. Now, UnitedHealthcare has accomplished that for the past 5 or 6 years. Before that, it was a little bit slow. So healthcare expenses have actually been accelerating over the past 5 years. I can't say whether or not that will continue. But what I'll say for the upcoming earnings is that UnitedHealth Group has been one of the most consistent companies in beating its forecasted earnings. For the past year, they've beat every single quarter. And I have no reason to believe that they won't beat this next quarter. The reason that I don't own UnitedHealth Group is not because I don't see the great fundamentals or even the great valuation. The company looks good all around, but the reason that I don't own it is specifically because it's in healthcare and insurance. These are both categories that I'm not that knowledgeable in. Healthcare is incredibly risky. There's lots of red tape and regulation, government intervention. There's lots of lawmakers always involved in healthcare. And then insurance is also a somewhat risky business. They use float, they use leverage. There's a lot of financial black box things that they do. So UnitedHealth Group is at the cross section of two industries of which I don't invest in either. I don't invest in healthcare and I don't invest in insurance. The company being a healthcare and insurance company means I'm not going to invest in it. Now, moving down the week, we have Wednesday. This Wednesday before market open, we have ASML, which is a company that a notable investor purchased a large amount, which was Dev Kantesaria. He's one that focuses on a super concentrated portfolio of high quality companies. And this is one that he's outlined. So anytime a big time investor, one that manages billions of dollars, that only has a handful of companies, and they have an extreme focus on filtering out the best companies in the world, they purchase one like this, that raises my eyebrows. That catches my attention. I looked into this one further, and it turned out that someone on our Discord had a lot of knowledge to share about this company. So what I'm going to read is one of the comments that was sent to me by someone on the Discord, part of the Patreon. And this, I think, is honestly the best overview of this company that I've ever seen. So let's go ahead and just take a look at this. He says, here's my take. We produce different kinds of machines, but the main focus is on the scanner part. The technology in these machines is a real monopoly. We're about 15 times more complex than the JWST telescope, and the newest generation of machines costs more than $400 million a piece. Those machines are being sold to mainly three big customers: TSMC, Samsung, and Intel, who make up over 80% of the customer base. So basically, with this first paragraph, we've established that they make machines that are 15 times more complex than the most complex telescope in the world. The newest generation ones are $400 million, so you're talking about $500 million per unit sold. They sell one thing, and that's $500 million. There's not many products like this on Earth. In fact, this may just be the only one like this on Earth. They do have a concentrated customer base, 80% of the sales into just three companies. So that's one thing to be aware of. If one of these companies were to move away from them, that'd be a significant blow of their revenue. But by the looks of this, it's nearly impossible to move away from them, at least suddenly. He says the machines itself consist out of over 100,000 unique parts and about 10 million lines of code. They're almost non-reproducible by other companies simply due to the ridiculous amount of complexity. Once a machine is sold, it will operate for around 7 years only at a before agreed upon 90% availability. The customer will have its initial investment back in about 6 months, which comes down to around a missed revenue of around $100,000 per hour that the machine is not running. So these machines that ASML sells are so critical in the manufacturing from TSMC, Samsung, and Intel that if they go down and they're not running, it costs the companies $100,000 per hour that they're not operational. That shows that you really have something people need. When the company goes down, when the machines break for whatever reason and they're not fixed, $100,000 per hour. Therefore, a huge amount of money is also coming in as a recurring in the form of maintenance. So they sell one of these machines for $400 million, and then ASML also sells contracts for maintenance. They're constantly making sure these machines are running correctly because it's so expensive to these companies if they go down. He says the machines itself work in air that's 10,000 times cleaner than the outside world. They take a few months to get installed and operational, and they make chips where the overlay is less than 3 nanometers. Also, the backlog we currently have is only growing, which takes out the cyclicality of the business. I am personally working on machines that will be ready in 2027. So they have employees here that are working on these super complex, incredibly expensive, massive machines, and they're working on ones right now that are going to be released in 3 or 4 years. So this company has a massive backlog. They have to do a lot of planning ahead. And this gives you a lot of visibility into the ongoing demand of the company. He says, and in the summer next year, I will actively start working on the newest ones, which will come into the market in 2034. They're working on ones that are like a decade out and will most likely sell for an outstanding $680 to $750 million a piece. This is an estimation. There is no exact number yet, but you can start your research following this video. and he links this documentary on ASML. So just to summarize what ASML, the stock, does, it's a company that makes this incredibly huge, expensive, complex machine that specifically focuses on one part of the supply chain of semiconductors or chips: lithography. Lithography, and how difficult it is to do this, how complex it is its competitive moat. Quite frankly, there's no other company in the world that can do what ASML can do because of how advanced and how complex the products are. There's another company that wants to get into the territory. I think they're dabbling with it, which I believe is Canon, but they're still not close. They're just not close to ASML. So in terms of monopolies, you can look at a lot of companies and you can say, oh, this is a monopoly, Apple's a monopoly, but every other monopoly has competitors, so they're not true monopolies. The only company right now that I really believe is a true monopoly is ASML. They have no competition. There is no other company on planet Earth today that can do what they do. So if you're looking for the truest version of a monopoly, right now I think ASML is it. When I look at this company in the upcoming earnings, I think it's going to continue to be good. We've seen ongoing demand in chip manufacturing, and ASML does have a huge backlog. But I do have my concerns with the valuation of the company. It now trades at a staggering 44 forward PE ratio and a 0.86% free cash flow yield. A lot of the gains have already come and gone. ASML is up 35% year to date. So it's had a huge run just recently. Then we look at the past 6 months and it's up 61%. So I was looking at this company a little bit more around a year ago, but with it being up 50, 60% in just the past 6 months, I've stayed out of it because I believe a lot of the easy gains in this company are gone. When I look at the company overall, the monopolistic position they have, the financials they have of incredibly fast growing revenue, explosive amounts of free cash flow, and more free cash flow per share growth expected in the future, I think this one's a good bet, and I don't blame anyone for having this one in their portfolio. So I really don't know which direction this one's going to go. I feel like there's so much priced into it that if there's any weakness in demand or any negative line in the earnings report, you may have a trade down. But overall, in the longer term perspective, I think ASML is an excellent stock. Now, moving on down the week, we move to Thursday after market close. We have the big one of the week, which is Netflix. Now, before we jump into this one, I must establish that I am an investor in Netflix. We can look at my total position here. This is in the Story Fund. This is a secondary portfolio where I invest in only a handful of companies, Amazon and Netflix being the two biggest ones by far. Netflix is 30% of the portfolio, now a total value of $65,000 with $18,000 in the green. So this one has been a decent one so far. I'm very bullish on it. I have been for a long period of time. Netflix has recently surged up, but I still believe there's a lot left to the story of Netflix. Now, a couple things I have to say about Netflix earnings in particular. You'll notice that when you look at this list, it's one of the only really exciting companies reporting earnings. Like, let's be honest here. A lot of these companies are just not that exciting. You have some financial firms, some brokerages, a lot of finance companies. Okay, those are a bit boring. There's no Tesla, Nvidia, or other exciting companies. This results in Netflix having a lot of focus for the week. Investors have 100% focus on this company because it's one of the only exciting ones reporting earnings in the entire week. So Netflix marches out there during earnings season on their own to kick things off. And that makes the earnings far more volatile. Netflix has one of the most volatile reactions to earnings of any company, typically up above 10% in gains or below 10% in losses. So if you're looking at Netflix and you're investing in this stock, you have to be aware of that. Don't be shocked if it goes up 10 or 15% or shocked if it drops 10 or 15%. Both of those have happened in virtually all of the earnings throughout history. The stock last quarter went up 10 or 15%. The stock a couple of quarters before that went down 10 or 15%. That's not a problem. It doesn't mean anything. The stock shoots up or shoots down, that's not an issue. In the case of Netflix, the highly volatile earnings is more a result of the surrounding optics and the situation of the reporting rather than the core fundamentals of the company. For example, another reason that I believe Netflix has incredibly volatile earnings is it's one of the only companies in the world that literally everyone has an opinion on. Every investor has an opinion on Netflix. You don't have the same opinion on other companies. What is your opinion on M&T Bank or Charles Schwab? You may not have a strong opinion on these companies. But if I ask you, what is your opinion on Netflix? Everyone will give an opinion because it's a product everyone has used. So every investor in the world has an opinion on Netflix, and they're one of the only companies that is important reporting earnings this week. There's a ton of opinions on this stock, a ton of options, a ton of betting, which results in ongoing volatility in the earnings. But again, I want to completely emphasize, whatever direction the earnings go, if it swings up 10% or down 10%, it's not the biggest deal for this company. And likely the fundamentals have moved far less than the stock price after earnings. There's a couple things that we can look at with Netflix and what I believe are the core key performance indicators of the company. And this will give you some perspective of my expectations for their next earnings. This is something that's still in development at Qualtrim, so these are not public, and they do need some work. For example, right here we have dollar symbols on the y-axis. Just ignore the dollar symbols. We're going to get that fixed before this is pushed live, but I'm showing you some behind the scenes inside baseball here. This is some of the charts we're creating. So for Netflix, we have a total subscriber chart over time. And this is in millions. Again, ignore the dollar sign. Just pretend it says 100 million here, 150 million. When you look at this chart, it doesn't look so bad. It just looks like Netflix is growing over time. This goes back to 2013. They had 34 million subscribers, 35, 41, 50, 66, 77 million. We're getting up to 2017. This is every single quarter, 104, 130, 150, 160. We get into COVID and they gain a lot in a short amount of time. 192, 195, 203. These were a lot of people locked in their houses. They couldn't move, so they had to sign up for Netflix to pass the time. Netflix is one of the cheapest forms of entertainment. Then we had it slowed down. It went to 221 million, and then they had a couple quarters where it went down a little bit. This is when Netflix sold off by 70%. Right there. You can barely see it on the chart when looking at the total subscribers, but the couple quarters where it dropped a couple million subscribers was so bad to the sentiment of the stock that it sold down 70%, causing even the likes of Bill Ackman to say the stock is no longer predictable. But this is on a longer timeline. This is the growth of Netflix over time. It grew all throughout 2013, 14, 15, 16, 17, 18, 19, 20, then a little bit of decline in 2021 with a lot of the people from COVID giving up their accounts, and then it continued growth back in 2022. Another chart that I think is interesting to look at, which shows the subscriber growth over time, is the net additions gained every single quarter. So this is the amount of subscribers Netflix either gained or lost every single quarter. And you can also see a lot of patterns here. Since 2013, they gained a little bit on Q1 of every year, a little bit more Q2, then more Q3, and then the most in Q4. So when everybody's at home during the holiday season, Christmas, you have all the holidays there, people like to be at home and watch movies together. So they gain the most subscribers there. And then it restarts. Beginning of the year, people are outdoors, they're exercising, they're traveling, they're doing stuff outside. So the subscriber net additions went down. But regardless, Netflix is gaining 1.86 million subscribers, 2.66 million, 3.8 million, and then 5 million. And we see this pattern roughly over and over again until we get into COVID. See the huge outlier right here? In one quarter, they gained 15.77 million subscribers. Netflix dumped all of their content all at once during COVID. That's when you had a lot of crazy shows like Tiger King, when people are stuck at home. And of course, they gained an outlandish amount of subscribers, 15.7 million in a single quarter. And then they followed that with another 10 million. Then the next year, it started to fizzle out and went back to the normal trend. And then they had the 2 consecutive quarters of subscriber losses. One of them due to pulling out of Russia, and the other one due to what they say was increased competition and what I assume is some churn from this quarter. They gained a ton in 2020. Some of those people decided to give up their subscriptions in around 2022. So what you see here is 2 quarters out of its entire history where they've lost subscribers. These 2 quarters alone, that tiny amount that they lost, one quarter being a loss of 200,000, the other quarter being a loss of 970,000, just losing that amount in 2 quarters caused the stock to go down minus 70%. During this time period, luckily I was able to avoid buying into the overall bad sentiment. I looked at the company and realized that they really were doing okay, that this wasn't a lot of subscribers in the grand scheme. And then Netflix also is a company that adapts quickly. They implemented their password sharing crackdown. They said that there's 100 million subscribers that are sharing passwords. And they're going to crack down on that, forcing them to pay or either not have the service. Then you saw subscriber growth start to grow again. In the next quarter, they gained 2.4 million, then 7.6 million. And then we skip over to the most recent quarters. Last quarter, they gained 13.13 million subscribers, a record Q4 for the company. Most of the subscribers gained here are on the ad tier, which is $7 a month. And they are subscribers that came from the password crackdown. So a lot of people that have been using Netflix for 10 years, sharing their parents' password, now they're kicked off their account and they're going, that sucks. I don't like this, but it's only $7. So I'm just going to pay for it. But overall, this should give you an idea of what it looks like. Netflix gains subscribers on 90% of their quarters. In some cases, they can lose a couple million here and there, but that shouldn't be an indication of the overall trend of the company. It feels really bad when they're losing subscribers. This wasn't a fun time. But again, it's not an overall indication of the long-term secular trends of the company. Now, another chart that I think is very interesting, and this is again going to be in the next release of Qualtrim with the KPIs, is Netflix's subscribers by region. So we can see in what region they're growing the most or not growing. And we can filter this at one region at a time. So if we look at the United States and Canada, this is their most mature market. Basically, everyone in the United States has a Netflix account or they've shared one before. And you can see that the growth doesn't look that great in the United States. It went from 66 million. Again, it says dollar amount here. Ignore that. That's going to be fixed before we release this. It should just be 66.6 million. Then the most recent quarter is 80 million. So they are still gaining subscribers in North America, but this is almost entirely due to the password crackdown. Everybody else has an account or they don't want an account. So there's almost no growth in North America. And if I was to guess, I don't think there's going to be a lot of growth in North America either. I think it will top out around 100 million. So we still have some growth here, but this isn't the main way that they grow. We move on to their next segment, which is Europe, the Middle East, and Africa. And you see still strong growth here. In 2019, they had 44 million subscribers. In 2021, it went up to 68 million. And then last quarter, it was 88 million. So they actually have more subscribers in Europe, Middle East, and Africa than they do in the US and Canada. And you're still seeing steady growth here. This market is not mature. It's going to continue growing. Then we move on to Latin America. This segment is also growing, but a bit slower than Netflix would like. They want this area to grow quickly. It's stagnated throughout 2021 into 2022, and it barely reaccelerated growth during the password crackdown. But you saw it go from 43 million to 46 million. So far, Latin America is one of the more disappointing areas, and I think that's a lack of good content for this geography. Netflix has made great content for United States and Europe. They haven't made a lot of great Latin American content, and they're trying to fix that. Then we move on to the last area here, which is Asia Pacific, and this is where they're seeing incredible success. South Korea has been a huge success for Netflix. So much so with Squid Game and all the different shows they're coming out with. They're now creating over 20 different South Korean content per year. And they're licensing a lot of content for South Korea. So South Korea has been a huge success, and even Asia Pacific overall has been a great success. Look at the growth rate here. This is their fastest growing region by far. They've gone from, in 2019, having 12 million subscribers here to having 45 million. And they can continue to make huge gains here, tens of millions. So when we break out the growth, United States and Canada, mostly saturated. Europe and the Middle East, not saturated yet. They still have growth here, but it's going to moderate. Latin America, they have a lot of work to do, a lot of content to gain. This isn't even close to saturated. There's a huge, long runway of growth ahead of them here. And then Asia Pacific, they are executing well, they're growing quickly, and this isn't close to saturated. If we switch over to another key performance indicator chart, we have the average revenue per subscriber. So this is basically, what are they charging these different regions, and what does the average price look like over time? As you can imagine, in their most developed market, which is the United States and Canada, the average revenue per subscriber is going up. They know that they've saturated this area and they've raised prices over time. This is true pricing power. Pricing power is not prices going down like crazy. Pricing power is charging more over time because you have a product that people can't replace. When we look at Netflix in the US, it was $11.52 in 2019. That was the average revenue per customer. In 2021, it moved up to $14.50. And now it's moved up to $16.29. Last quarter, it was $16.64. Now, They introduced a new ad tier, which is $7 per month. That's super cheap. So most people will do this over downloading it illegally online or choosing a different plan. If they want a super cheap plan, they can just do this. And Netflix is pricing this, so it's $7 per month, plus you get a few ads. The ads make up for around $8 per month. So Netflix makes around $15 per month from the ad tier. And that should go up over time because the ads become more efficient for Netflix as they get more people on the advertising tier. So the average revenue per subscriber in the US is going up over time as this is a saturated market. Now in Europe, Middle East, and Africa, the average revenue per subscriber is a lot lower than in the US. It goes down to $10.75. And they're keeping it around the same because they still have a lot of market to gain here. So they're going for more of a land grab. They're trying to gain more subscribers here, which they're successfully doing. If we move on to Latin America, the average revenue per subscriber goes down a little bit more. It's now down to $8.60. Again, it was around $16 in the United States. So they have to price this according to the economies and how saturated they are in these countries. When we look at Asia Pacific, Netflix has reduced the prices over time to gain additional subscribers. I think Netflix is following the proven playbook here of pricing appropriately, gaining a lot of subscribers every single quarter, and then once they reach saturation like in the US, that's when they can go back to raising prices. So I like the strategy they're doing here. So overall, when I look at all of these key performance indicators, when I look over the fundamentals of Netflix, I see a company that is steadily growing over time. They're executing well across different geographies. And for the most part, they gain subscribers every single quarter, except for two in their entire history. They took a beating for that, but they're back to growth. Wall Street says that Netflix needs to put on another big subscriber show. They say that analysts are expecting a little over 4 million net new subscribers this next quarter. But they say according to conversations with investors, they're expecting 4.5 million to 6 million. Though we recognize investors' expectations are more likely towards 7 to 8 million. So here we have this huge range between 4 million to 8 million. So expectations for subscribers gained this quarter are really all over the place. Investors do not know what to expect, but I'll go ahead and give you my take. My expectation as an investor is I think they're going to do really well this quarter. I think they're going to gain upwards of 4 million or above. That would be my guess. But even in the case that they don't, even if they have a slowdown and they gain 1 million or something that's really disappointing to Wall Street, I'm not going to be concerned about this because I've looked over the overall history of Netflix. I know how this company works. Subscribers come and go every single day of the week. Every day, there's thousands of people canceling their Netflix subscription or signing up. In the course of 3 months, there's millions that have left the service and millions that have joined the service. So it's a constant highway of people coming and going. And overall, in most cases, that net's positive, but there's some periods where it's a little bit slower. That doesn't concern me about the overall of the company. So even though I think this next quarter will be good, and I think they'll gain subscribers, they've had a lot of great shows out recently, including one that they show a picture of here. The Gentleman, which is another huge hit for Netflix, a Guy Ritchie series. Even though they've had a lot of shows like this and things look good overall, I'm just not concerned if they do poorly this next quarter. It won't be concerning to me. I'd have to see real convincing evidence that Netflix is in fundamental trouble to become concerned about this stock. And I just don't see that with any of the numbers. Netflix has routinely missed their subscriber expectations all throughout their history. They do it routinely. They miss all the time. And the stock has still been one of the best performing stocks in the world. The company has still grown fundamentally over time because people focus on quarter to quarter instead of the bigger picture. Now, another thing I consider in the upcoming quarter is the expectations that are baked into the company. Right now, Netflix has recently performed really well. It's up 31% year to date, which has outperformed Disney. Even with them trying to recover, Netflix has just flown up. In the past year, it's up 85%. And from the lows, it's up around 250%. So this company has been an incredible performer, and the valuation has become a little bit more rich. When we look at the valuation now, it's traded from a 18 PE ratio back up to a 36 forward PE ratio. So it's at a higher PE, and then the free cash flow yield is at 2.58%. They don't do a lot of stock-based comps, so that's not an issue for the company. When I look at the valuation of the stock, I also look at their free cash flow expectation this year. Last year, they printed $7 billion in free cash flow. This year, they're projecting $6 billion, but I think it's going to be closer to $7 billion again. because Netflix usually doesn't spend quite as much on content as they say they're going to. So I think we're going to have a valuation of around $7 billion of free cash flow. I think they'll do some buybacks. And I think that puts Netflix right now around a 2.7% free cash flow yield. I know it's crazy after the recent rise, but to me, that's still not too expensive. I still think there's more upside to Netflix. So the stakes are higher for Netflix. The valuation's higher. It's going to be a more dramatic earnings, but I'm still very bullish on the company. I still really view this one as positive with so many secular trends, with so much strength going for the next couple of years. So I'm holding on to my Netflix. I'm crossing my fingers for the best, but I'm not going to be too disappointed if it has a big sell-off. It's happened over and over again with this company. If it goes down 10 or 15%, it'll be just another sell-off. Now let's go ahead and move on to Friday before market open. We have American Express. American Express is a great company, and it's similar to one I own, which is MasterCard, but it has some key differences. American Express trades at roughly half the valuation of MasterCard, or even cheaper, because MasterCard is purely a digital network company that networks together different parties through a complex transaction. So MasterCard has this impenetrable moat. It's a company that's incredibly difficult to have any type of downside risk in. American Express is different because they run as a bank. They lend out money. That additional risk in running as a bank and lending out money has made the company a little bit in trouble in times in the past. So they are priced with that potential, being at a 17 forward PE, 10% free cash flow yield. A lot of this is due to their banking activity. Regardless, this company has been on a roll recently. Over the past couple of years, they've grown a lot, so American Express has been executing well. Their free cash flow has also been gaining momentum over the past couple of years. And if I had to guess, I believe that American Express will beat their earnings. We already saw the report from Goldman Sachs. High net worth individuals, wealth management companies are doing really well. American Express caters to a lot of people that have higher income. So if they're doing well, they're spending money, they're using their services, American Express is going to do well. Even though I don't invest in Procter Gamble, I'm always excited to see what the company does because it represents a big portion of defensive companies, consumer staples, and the broader retail industry. Procter Gamble grows a little too slow for the type of companies that I invest in. Both the top line growth has been underwhelming, growing along with GDP as a very large, mature company, but also the free cash flow per share growth has been around 5 to 6% per year. That's a bit below the average of the S&P 500. So this company's growing at 5 or 6%. I'm targeting companies that I think will grow around 15%. So I'm targeting companies I think will grow roughly 2 to 3 times faster than Procter & Gamble. I'm going to make a prediction here that might seem a little off, but there is a reason behind this. I think Procter & Gamble will miss on its earnings per share. Now, there's no guarantees, so don't bet on this. I can't see the future, but I think they'll miss on their earnings per share estimates. We just had a recent interview with the CEO of Amazon, Andy Jassy, who recently said that there's a strong amount of trade down with customers. They're not buying the high-end consumer defensive stuff. They're buying the generic no-name stuff. Even if it's a little bit cheaper, they're buying more generic stuff. It's true that Procter & Gamble does have some white label stuff or some generic stuff, but most of their profits come from their name brand products. And if customers are trading to more of the generics, if they're trading to more of the white label stuff, if they're moving from Procter Gamble to Kirkland Signature, that will hurt their margins to some degree. So I'd not be surprised if we see similar trends on Amazon that we do in general retail. I would not be surprised if Procter & Gamble had disappointing earnings. But that is a look at the top companies of this week. If you want to see a follow-up on these earnings reports, I'm going to be reviewing many of them. So make sure you subscribe to the channel, make sure you have the bell notification on. And then next week, of course, we have an even busier earnings week. So I'll have another video out for that. Make sure you subscribe. That's all for now.